Hey everyone, welcome back to Corporate Decoder. Today we're diving into Moatable Inc.'s annual report, and let me tell you, it's less smooth sailing and more like navigating a boat with a few holes. We'll decode their year-end financials, revenue, profits, risks, and strategy. Also, you can understand what this company is really up to. Moatable Inc. is currently running two software businesses in the US, Lofty and TruckerPath. Let's start with what they do. Lofty aims to help real estate folks close deals faster using their software. Then there's TruckerPath, which offers mobile services for truckers in North America. Think trip planning and finding the best routes. The company believes its culture focuses managers and operating personnel on achieving growth efficiently. They closely watch operating performance, cash, and key measures like customer acquisition cost. Moatable's strategy is pretty straightforward. They want to increase their customer base, get more revenue from existing customers, and look for partnerships and acquisitions. Now for the important disclaimer. This report contains forward-looking statements, so keep in mind that their plans are not a guarantee. Let's get to the nitty-gritty. Moatable has a history of losses, and they expect it might continue. Their operations lost millions, but at least they are trying to become profitable. Renewal rates could decline, which would harm future revenue. This is always a big risk when you depend on people renewing subscriptions. If people don't resubscribe, the business suffers. The software market is competitive and intense. Both established and new companies are offering similar products, and that makes things tough. They also mentioned that competitors might have more money or better relationships with potential customers. Their SaaS products serve cyclical market segments, and economic downturns can hit them hard. For example, the success of Lofty depends on the health of the real estate market, which is influenced by interest rates, employment, and the overall economy. If they fail to market effectively and sell their products, it could seriously harm their business. If they fail to maintain their existing brand awareness, their ability to expand their customer base will be impaired and their financial condition may suffer. If there are security concerns about the online payment systems we use, it could damage our reputation and deter current and potential users from using our services. Cyber attacks, viruses, and break-ins to their computer systems could result in misuse of confidential information, which may adversely impact our results of operations and financial condition. Here's where it gets a little complicated. Their dual-class voting structure gives the largest shareholder, who is their founder, chairman, and CEO, significant power, which could discourage others from pursuing any change of control transactions. This means it's harder for outside investors to make big changes. And here's a fun one. If the PCAOB, which is like the police for company auditors, can't inspect their auditors, the SEC, who are in charge of the markets, will ban the trading of the ADSs. A trading prohibition may materially and adversely affect the value of your investment. The aggregate market value of shares held by non-affiliates was approximately $11.7 million. This is a rough estimate of the company's public float, or the value of shares actually available to trade. Time to switch gears from risks to actual financial performance. Alright, here are some numbers. Their revenue increased by about 22%, going from $52 million. That's solid growth. The important thing is that most of this increase came from subscription services, which is the revenue they can count on and expect to reoccur. Subscriber count rose, but advertising revenue didn't grow. Their cost of revenue increased and their gross margins decreased. That means the percentage of revenue they keep as profit has gone down a bit. The expenses were for their operations and the move into Europe. Selling and marketing expenses got a little cheaper. However, their research and development spending went up a bit as they expand. Now, this is not great. They report that they found material weaknesses in their accounting. They have issues assessing risk, calculating sales tax, and evaluating internal controls to find and fix problems. This means investors might worry about their numbers. The chief executive officer also has management responsibilities at another company, which may divert his attention from the operation of our business. The regulations of foreign investment could mean changes in how they operate in China, but they're unsure what that means exactly. The PCAOB in China could cause trading in our company's securities to be prohibited. This is related to taxes. They may be classified as a passive foreign investment company, which could mean higher taxes for shareholders. Our company's current auditor, Markham Asia CPS LLT, is subject to laws in the US to assess compliance with the applicable professional standards. Markham Asia is headquartered in New York. Holders of ADSs will not be able to exercise voting rights attaching to the underlying Class A ordinary shares represented by the ADSs on an individual basis, but to elect the depository. The market price for the ADSs may be highly volatile and subject to wide fluctuations in response to factors including the following. The ADSs are quoted on the OTC market, which may have an unfavorable impact on their trading price and liquidity. The quotation of the ADS on the OTC market may result in a less liquid market. Security concerns about online payment systems we use could damage our reputation and deter current and potential users from using our services. Our access to funding sources and other credit arrangements in amounts adequate to finance or capitalize our current and projected future business operations could be significantly impaired. We transitioned from a foreign private issuer to a US domestic issuer, with the majority of our revenue generated from our SaaS businesses. Operating expenses decreased from $52 million in 2023 to $51.3 million in 2024, primarily due to decrease of impairment of goodwill and intangible assets, and partially offset by business expansion. They have about $700,000 of Class A ordinary shares and some small amounts of capital relating to land and liabilities. The accumulated deficit is massive. They show a good amount of cash at hand, meaning they will have money to use for growth for a little while. So Moatable looks like it's at a turning point. While the revenue growth is encouraging, those accounting issues need to be addressed to build investor confidence. Their path will really depend on their ability to keep growing their core businesses while carefully managing costs. The business is a bit shaky. Hopefully they can steer it into a safe harbor. Their leadership structure and the risks that leadership possess seems pretty standard. They depend heavily on the founder. Ultimately, this is risky but common in smaller orgs. Their decision to operate inside China comes with inherent geopolitical regulatory risks, something to keep in mind depending on your specific situation. Thanks for tuning in to Corporate Decoder. Did this deep dive help you understand Moatable a little better? Let us know in the comments. Don't forget to like and subscribe for more straight talking analyses.